Good afternoon and welcome to another edition of Facebook Live. If you missed the On the Money show yesterday on Super Bowl Sunday, we talked about why sitting in cash may be more dangerous than even being in the market. You know, in the 2008 financial crisis, the stock market erased nearly $7 trillion in shareholder wealth. And if you personally lost money in 2008, like so many Americans did, you know what that felt like. It was a real sucker punch to the gut, especially if you were near retirement. And while some people licked their wounds and stayed in the market, others can still feel the sting of those losses today. They fear the stock market. They don't trust the stock market. And I can't tell you how many people I see on a daily and weekly basis that have a lot of money just really tied up in cash. Savers refuse to become investors because they're terrified of the unknown. In their minds, it makes more sense to avoid the known risk. But if they did the math, they might think otherwise. Based on some research that I've done, you have a staggering 81% chance of running out of money when taking 4% withdrawals made up from a portfolio made up of cash holdings during a 30-year retirement. With a portfolio of 60% stocks and 40% bonds, you'd have just an 8% chance of running out. And don't gloss over that conclusion. Safety seekers are 10 times more likely to run out of money by refusing to invest. Good, bad, or otherwise, disappointment in interest rates and a refusal to take a stake in stock and bond market investments have spurred the popularity of insurance-based products such as annuities. According to the Retirement Institute, roughly $230 billion of annuities are going to be sold in 2016. The idea is to pass some of that market risk onto the insurance companies. Depending on the type of annuity, you either get a portion of the market upside net fees or you simply receive a fixed rate of return. But as with any product, it behooves you to understand all sides of the coin. Familiarizing yourself with jargon such as surrender periods, mortality and expense charges, participation rates, cap rates, and annuitization is a great place to start. But no matter what people tell you, there's always going to be risk. The second you avoid the risk of the equity and the bond markets, you're going to instantly subject yourself to liquidity risk, inflation risk, and the risk of an insurance company failure. You cannot avoid risk, despite what advertisers will tell you. Again, according to a new study by Bankrate.com, it seems that Americans are keeping more money in cash far longer than they should. Some 54 million Americans prefer cash investments with money that's not even needed for more than 10 years out. Now, there's no rule of thumb for how long you should keep your funds in cash, but it's useful to think of cash vehicles such as money market funds as holding places for money you would need in the next 1 to 5 years. Again, 1 to 5 years, you ought to be keeping the money safe. Anything longer than 5 years, you might be able to dip your toe into the investing marketplace. But again, we don't see that in reality. Most people are keeping money in cash way too long. They're waiting. Consequently, they're missing out on returns. What it basically boils down to, and there's 10 things that I wrapped up yesterday with, 10 retirement investing rules you should know by heart at any age. First rule is have a plan. You got to have a plan. It doesn't matter what type of investment you have if you don't have a plan on how it's all going to tie together. Start saving early and aggressively. Take advantage of tax-advantaged accounts, i.e. your 401k plans, your IRAs. Take what the government gives you. As I mentioned earlier, don't bail out of stocks entirely. You ought to have some portion as an inflation hedge in your portfolio. Favor dividend-paying stocks. Kind of interesting, from 1927 to 2014, dividend-paying stocks outperformed non-dividend-paying stocks, averaging 10.4 annual growth versus 8.5. Pretty big difference. You also should consider annuities. It is a great way to take pressure off yourself in retirement. If you build an annuity or two into your investment portfolio, you receive dependable income without having to keep track of the investments. Something I mentioned in the past, pay attention to fees. If you're going to be doing investing, look at what fees you're paying either in your brokerage account to your investment advisor or even the expense ratios on your mutual fund accounts. Be smart about Social Security. Social Security's got to be tied in with what you're doing from an income planning standpoint. Last but not least, always consider hiring a pro. It's tough to do it yourself sometimes. You're too busy with your career, your schedule, and a lot of times you just don't have the time to get in depth to this as deeply as you'd want. It always makes sense to hire a pro. This is another edition of Facebook Live. Have a great week.